Okay, so having digressed about the Bank of England and explained the clearing system, we now go back to looking at our normal bank in a bit more detail. So here we are back to our normal bank. The spreadsheet has been updated because A put in £6, B 10 and C 4. Then A bought a pig from B, so he went down to 3, B went up to 13. So it raises the question, can the spreadsheet have negative numbers in it? So if it has negative numbers in it, it's a bit like me having no money and going to the bank and taking money out. That would naturally, mathematically, give me a negative number. So can I take money out of the bank that I never put in? And the answer is yes, or at least the mathematics does work. Okay? So A had £3, B had £13. Suppose A buys another £7 of goods from B. Okay, well, if you just take 7 off 3, you get -4. If you add 7 to 13, you get 20. So the maths happens, and the bank is still in the same position of solvency. This plus 6 equals 20, plus the 5 the bank had originally, okay, equals the £25 of physical cash that's in the reserves of the bank. So that's fine. The maths all seems to work. But it raises the question, does A now owe B money? Because A has a negative amount, okay? Does A owe B money? Well, no, A does not owe B money. So A owes the bank, and the bank owes B. So let's go back and look at that again. This -4 means A has now effectively taken more money out of the bank than it's put in. So A now owes the bank. So A has a liability of £4 to the bank, and the bank has an asset of £4 that A owes to the bank. B now has an asset of £20, which is a liability of the bank. But A does not owe B. The bank acts as an intermediary, and this is really, I suppose, the second really massive feature of banks, or perhaps the third if you think the operating the checking system. So the banks keep your money safe. They operate the checking system, they operate the sort of scoreboard of the financial system, and also they act as intermediaries, so debtors are not a risk to creditors. Okay, and this is really fundamental, that the A owes the bank and the bank owes B. So that is how that structure works. So B doesn't have to worry about the fact that A is in debt and might default. However, what if A cannot pay? So A has effectively taken more money out of the bank than it's put in, on the premise that it will put the money back in at some point in the future. But what if it can't? Businesses go bankrupt and the rest of it, so what if it can't? Well, if we think it through, if A cannot pay, then B still has £20. Okay, A effectively has 0 now, because A did have -4, but if A cannot pay, it effectively becomes 0 because it has defaulted. So bank still physically has 25 in its vault. That money hasn't physically moved, but its net asset position is now 25 minus the 20 that it owes B minus the 4 that it owes C equals £1. So let's look back at the spreadsheet. Okay, the net asset position of the bank was 25 minus the 4 minus 20 plus this 4. But if A defaults and this becomes 0 because it's defaulted, then the net asset position of the bank becomes 25 minus 4 minus 20, which is 1. Okay? So are B and C now worried? So fundamentally the bank has lost money. The bank has lost its money because its debtor A has defaulted. So should B and C be worried? And the answer is no, because the total deposits of B and C are 24. So the total reserves of the bank are 25. So B and C know that their money is completely safe despite the default of A, because there's still more money in the bank, more physical cash in the bank than the total of their deposits. So both B and C can take all their money out of the bank, and the bank will not run out of money. However, you can see where this is going. What if somebody else comes along? Okay, D wishes to borrow £80 to buy £80 of goods from B. Okay, so now we've got this additional client of the bank, D, who now has minus £80. So he buys £80 from B. B goes up from 20 to 100. Okay, well, it still looks superficially fine. Okay, I've I've reinstated A's overdraft there. So we now have plus 20 here. Total liabilities are plus 20, minus 4 plus 100, plus 4 minus 80. Total assets 25. So the net asset position of the bank is still plus 5. So the spreadsheet just works in the normal way. So there's nothing mathematically problematic. However, there is a bit of a problem now if D defaults. So are B and C now worried? Okay, they weren't worried before because the total assets in the bank was more than the total of their deposits. And the answer is now B and C should be worried because the total deposits now of B and C are 104 and the total reserves of the bank are 25. So supposing B and C now think, well, I'm not sure that A and D are going to be good for their debts, so I'm going to try and get my money out. There's £25 of cash in the bank, and both B and C run the risk of not getting their money. If B tries to get its money out first, it'll get £25, and there'll be none left for C. If C tries to get its money out first, there'll be £21 left, and that's all that B will get. So both B and C are now in a position where they're thinking, well, the first one to get the money out gets the whole 20, well, or in the case of B gets the whole 25, in the case of C gets the £4. If they're second in the queue, they will get, in the case of B, they'll only get £21. In the case of C, they'll get nothing. So both B and C are looking to get their money out of the bank first, if they believe there's a risk that A and D will default. And that does happen, and it's what we call a run on a bank. And it happened at Northern Rock about 10 years ago. It hadn't happened for 150 years before that. But once you get to a situation where the depositors start to think that the bank, the debtors on the bank might not be good for their debts and the reserves are not good enough to cover the deposits, then it is in your interest to get the money out of the bank first. So is it allowed? Is the bank fundamentally allowed to do this thing where it has this sort of structure? Okay? Where the total amount of the deposits is more than the total amount of reserves because you have these debts. Okay, so the whole security of the bank depends on these private individuals being good for their debts. And the answer to that question is yes, it is allowed, and it's called fractional reserving. Okay, it's a fundamental property of how the banking system works. It's a source of politically contentious issue, although not that many politicians understand it well enough to make it contentious. But you are allowed, banks are perfectly allowed to do it, and it's called fractional reserving. And what it means is the bank only holds a fraction of the reserves it needs to back the outstanding deposits. So to do that, it has to be regulated so that it can't be abused, or to make it as secure as possible. And that's what Basel II is really about. So you might hear about Sarbanes-Oxley, which regulates the accounting profession, Solvency II for insurance. Well, Basel II is the big piece of regulation for the banking profession, and it stipulates the amount of reserves that must be held, and very important, the quality of assets and loans that are required. So something like an unsecured loan, like a car loan, typically you'd require more of those sorts of assets as collateral, but something like a mortgage, where you've got a house that backs the loan, you would require less of that. So there's rules about how much loans the bank must have, and what quality those loans must be, in order to allow them to operate this system where the total amount of deposits is more than the total amount of actual physical cash reserves that they hold. So it's the job of the rating agencies, people like Standard & Poor's, Moody's and Fitch, to assess whether bonds and synthetic bonds are of the right quality. Because if we go back to the spreadsheet here, okay, in many cases, this is an asset of the bank. D owes this money. Now, if D has just bought something with it, but it's not collateralized, that's a poor quality asset for the bank. If D has bought a house and the bank holds the mortgage of the house as collateral for the mortgage, that's a much higher quality. It could be that D is a corporation and this is a AAA bond or something like that, so it could be very secure. So the job of the rating agencies is, in the case of the corporate debt and synthetic debt, to assess how good quality this asset is. Okay, because this minus 80 is an asset for the bank. The bank owns this, and it needs this because it owes B and C £100 or £4. Okay, so it's the job of the rating agencies to assess how good quality this debt is. That's fundamentally what they do. And when you see ratings like AA and AA plus and that kind of thing, they are different ratings to assess different qualities. So AAA is typically the highest rating, the best quality, and something like C, it will be the lowest quality, and then D typically means that the bond is actually in default and is not worth anything. So that's what rating agencies do. Then the next job we look at here is the auditors. So auditors are companies like PwC, like Ernst & Young, like Deloitte and Touche. They are big accountancy firms, and their job is to check that the banks are actually holding the assets they say they're holding. Now, auditors don't just do that for banks, they do it for all companies that are listed on the stock market. They go through the report and accounts and check that what it says in the accounts is actually a true and fair reflection of what the business is actually doing. And they do that for the banks as well. So you've got these two pieces of checking. The rating agencies check the quality of each individual bond, each individual synthetic bond, and the auditors check that the banks are genuinely holding what they say they hold. And in addition to the auditors and the rating agencies, the bank will have their own risk management team which run daily simulations to stress test the risk that the bank is exposed to. Okay, so they'll actually be running stochastic models, Monte Carlo simulations, to try and assess whether the bank is genuinely able to withstand different scenarios, like several bonds defaulting or interest rates changing, currency rates changing will affect all sorts of things where assets might be held in different currencies from liabilities. So the bank's own risk management team will be assessing that on a daily basis. Okay, so that covers the issue of negative numbers. Okay, and so the question that arises is, why don't we just ban the negative numbers? Okay, they cause all these problems, they need all this regulation, they were fundamentally behind why the credit crunch happened in the first place. So it raises the question why we don't just ban them, and we'll come on to that on the next lecture.